Hello, everybody. Welcome to today's webinar, An Economic Outlook for Small Business Owners. My name is Meredith Medlin, and I'm so glad to have you with us today. Thank you all for joining. I serve as the Director of Partnerships and Impact for Accion Opportunity Fund, which is a national nonprofit organization that provides affordable loan capital as well as wraparound business resources to small business owners across the country, with a specific focus on entrepreneurs of color and women entrepreneurs. Today's discussion will give you some important insights into the economic trajectory that our country is on based on all of what I think are very crazy events that have happened in the past year. So we'll also discuss how these economic conditions could affect your business, as well as how you can respond and then proactively prepare for what's ahead. Accion Opportunity Fund is really proud to support entrepreneurs through both access to capital and educational opportunities like today's discussion. And we are so grateful to our partners at Fifth Third Bank for sharing our commitment to small business. Before we dive into our discussion today, I just quickly want to introduce my colleague, Philip Henry from Fifth Third Bank, who will share a bit about the bank's commitment to the community. Thanks for being with us, Philip.
Hi, thank you, Meredith. And good afternoon, everyone. I'm Philip Henry, Corporate Social Responsibility Manager for Fifth Third Bank. And once again, thank you for joining today's webinar, An Economic Outlook for Small Business Owners, our first small business webinar of 2021 in partnership with Accion Opportunity Fund. Our commitment to put business customers at the center of everything we do is a driving force behind our ongoing collaboration and partnership with Accion Opportunity Fund. Together, we share a common goal, and that's helping entrepreneurs overcome barriers and achieve business growth by expanding access to capital and educational resources. Fifth Third Bank, in collaboration with the National Community Reinvestment Coalition, made a commitment to invest $32 billion into the communities that we serve through 2020. We have exceeded our commitment with significant help and engagement with community and business partner organizations such as Accion Opportunity Fund. As you can see from the slide here, we have completed the 5-year plan with $41.6 billion in lending and investments to improve lives in low to moderate income communities throughout our 10-state footprint. We have committed $16.3 billion in mortgage lending, $12.6 billion in small business lending, and $11.4 billion in community development lending and investments. Fifth Third Bank is committed to all the markets that we serve. Several hundred entrepreneurs have been helped through our support of economic development programs, including technical assistance and micro lending for small businesses through partners like Accion Opportunity Fund. If you're launching your business or expanding it, our team at Fifth Third and our resources are available to you every step of the way. Please visit our Business Resource Center at 53.com and let us help you meet your financial goals and assist you with smart financial solutions for both your personal and business needs. Thank you all, and back to you, Meredith.
Thank you so much, Philip. We are so excited to be continuing our strong partnership with Fifth Third Bank. And now I'm excited to get started with our discussion about the economic outlook for small business owners right now. I'm really pleased to introduce our panelists. So today's experts include Tom Jalics, who's the Chief Market Officer at Fifth Third Bank. Thanks so much for being here, Tom.
Thanks for having me, Meredith.
Great. And I'm also excited to welcome my colleague, Luis Ramos, who serves as AOF's Director of Business Advising. So glad to have you here, Luis.
Of course. Thanks, Meredith.
All right. So let's go ahead and get started with this conversation. First, we are going to discuss America's recent economic journey, the things that have been going on for the recent past year. So, Tom, can you please help us understand a bit more about how the economic shifts that the COVID-19 pandemic has caused, how those have affected our economy?
Absolutely. It's a great question. Thanks again for the invite. It's always great to spend time with everybody here today. I hope in the next not too distant future, we're able to do it face to face. I think, like everybody, we've been through a slew of Zoom meetings, and I'm looking forward to having a cup of coffee or lunch with all you face to face. But to answer your question, there's been significant shifts from an economic perspective. They kind of have been supercharged as we've gone through the pandemic. I should say that as part of my job at the bank, what I really do is lead a group of investment professionals, and our job is ultimately to make investment decisions between 5 main asset classes on the wealth management side: stocks, bonds, cash, real assets, and alternative investments. That we then make recommendations to our wealth management clients that ultimately guide the decisions for their investment portfolios. One of our core tenets is that if we can properly identify the phase of the business cycle that we're in, we'll make fewer investment mistakes, right? And that sounds like an easy job, but it's more difficult than it sounds, in that economies and financial markets are dynamic, they're not static. That being said, we feel pretty strongly, we have a lot of conviction on where we are today. We think we're at the very beginning of a new economic cycle. I know it doesn't feel like it in a lot of respects. There's still lots of sectors or industries in our economy that are struggling. We've kind of been calling them, for the lack of a better word, we borrowed this from a good friend of ours, the scene of the crime industries. And these are the industries that you really can't socially distance from. And ultimately, they're a lot of the industries that we love as individuals to take part in. It's, travel, leisure, hospitality, hotels, restaurants, bars, airlines, cruise ships, movies, sporting events, plays. These are the last groups of industries that are going to come back because they're very difficult to socially distance from. That being said, much of the economy is really doing quite well, whether it is manufacturing, whether it is housing or home building. There's these learn from home, spend from home, work from home industries that are doing quite well. So again, we're in the early stages of a new expansion. If past is prologue, at least going back to about 1980, these expansions typically last 5 to 7 years on average. The one that ended, March of 2020 was 11 years. This has big implications for, business leaders, business owners, and investors. If I could tell you that you could start really investing in your business, in your company, or setting up your investment portfolio for, an expansion that is expected to last many quarters and many years, I think you try to take advantage of that if you could. But to answer your direct questions, that's where we think we are in the cycle. We think we're in a brand new cycle, in the early stages, first inning of a new cycle. They typically last many quarters and many years, but kind of what's changed? And I mentioned it a little bit. We think the pandemic served as a disruptor and kind of a trend supercharger. Obviously the economy shut down last March. All businesses, essential businesses, other businesses were kind of shut down in March, April, and May, and then the economy started to reopen. We were forced to rethink the way that we interacted with commerce, and some of the ways that I think we were forced to think about re-engaging with commerce are going to be here. They had been here for a long time, but I think now these trends have been supercharged. And a couple of them, let me just touch on briefly. It's the spend from home notion, right? Remember March, April, May of last year, grocery stores were either closed or very difficult to get the supplies that you needed. Brick and mortar retail shops were largely shut down, and we have been a society that has been growing our online shopping presence for 20 years. And we really supercharged that trend in March, April, May, and June of last year. We continue to think that trend, this notion that you're going to continue to spend from home, buy online, have it delivered to your house rather than exclusively go to brick and mortar. We think that trend is going to continue. I think it's got very long legs. And if I was a business owner, I would be thinking about how to take advantage of that for my business, having a strong online presence, have a great logistical back office. And as an investor, those are kind of the industries and companies that I'd be thinking about investing in. So spend from home, we think supercharged last year, it's here to stay. I don't think I'm really talking out of school. I think we've all seen this. I could show you slides about, where even big ticket items, cars and homes are now, it's easier to buy those things online where they were prior to the pandemic. So spend from home is here to stay. We think the work from home trend is the other big kind of supercharged event. Prior to the pandemic, about 80% of the US population, the workforce, was going into an office, going into a work setting, and only about 20% were either fully working remotely or partially working remotely. During the grips of the worst part of the shutdown in March, April, May, it kind of flip-flopped, where about 40% of the employees were going into the office and 60 to 65% were working remotely at some way, shape, or form. We think a lot of businesses have shown that they can have additional workers work remotely. I think a lot of the workers have found that they, after a transition period, enjoy it, a little bit more flexibility, cut down on your commute. And I think the employers who ultimately have office spaces in various parts of the country are noticing that perhaps their commercial real estate footprint can be shrunk a little bit. They can save some costs. This work from home trend, we think, is set to again, it's been supercharged through the pandemic, and it's going to be here for many quarters and many, many years. And it has big implications for transportation, particularly public transportation, where big companies are located. Perhaps, if you're a Fortune 500 company and you have office space in Manhattan and you're going to allow your workers to work remotely, perhaps you're moving that core office space, or you're leasing fewer floors, and you're allowing your employees to be a little bit more flexible in where they work. So there's commercial real estate implications. There's residential real estate implications if people are allowed to work remotely. Perhaps the most densely, very expensive parts of our country will see a little bit of migration out of those areas into less densely populated areas. We're starting to see it in some of the numbers. Again, big cities are not going anywhere, but we think there's going to be a transition period. Again, this work from home trend, big implications for commercial real estate, residential real estate, and migratory patterns, urban to suburban, large city to mid-sized city. And then the last one I'll talk about is we're starting to see migratory patterns from high tax states to lower tax states. We think these trends are going to be here for quite a while. So those are some of the shifts caused by the pandemic. We think they really were kind of in place before the pandemic last year, but they've been supercharged. And it's a great question. I'm happy to go into it in more detail if we have time later, but thank you.
Yeah, that's so interesting, Tom. I think it's helpful to think about these shifts that we've all experienced, in our personal lives over the past year, but think about the economic ramifications of it. And, I'm working from home, but what does that mean when everybody is working from home? So that's really interesting. Thank you for sharing that. The next question that I want to turn to here, now that we've looked back a bit, and you spoke about this because we're still somewhat in the middle of this, starting to come out of it. What's happening right now with the economy?
So the economy is really, really improving. Again, I've done these presentations and had these conversations with individuals who are taking part in the economic expansion in the region. And I've definitely talked to business owners that have not. Again, there's this population, or there's this sector industries that I kind of mentioned earlier that are not back to full capacity. We love them as consumers. These are the things that we love spending our discretionary dollars on. They make life worth living to a large extent. And again, it's a lot of leisure industries, hospitality industries, travel industries, hotels, restaurants, bars, sporting events, plays, movies, cruise ships, casinos, all these things. It's this last piece of the puzzle to our economy to get it back up and running at full strength. And we're not quite there yet, because there's still, issues around socially distancing. There's still certain states that have some restrictions put up there. But I will tell you, as we are, 4+ months into 2021, these restrictions are coming down, and these scene of the crime industries are opening up, which is great for all of us who enjoy these industries, but it's really great for those business owners that are involved in it. I think those business owners in particular have taken the brunt of the downturn squarely on their shoulders, and it's been a very, very difficult time for them. The thing that, to no one's surprise, that is really helping bring these scene of the crime industries back is the vaccination program. And the United States vaccination program has been truly tremendous. I know there's been hiccups. There was some rollout issues in December and January, but aside from really Israel and the UK, the United States is really the world leader in getting this vaccine for COVID-19 out to its population. As of the end of April, make sure I get my numbers right, roughly 40% of the US population over 18 years old was fully vaccinated, and about 55% of, again, the population over 18 years old at the end of April had received at least one dose of the vaccine. So our view has been, as these vaccines are rolled out, the risk to the worst outcomes from COVID to the most at-risk parts of our population will start declining, and that's exactly what we're seeing. We're seeing case counts decline from January highs. We're seeing hospitalizations decline from January highs. We're seeing, most importantly, of course, fatalities decline from January highs. And this is really important, not only from a health perspective and a social perspective, which again is paramount to everybody on the call. secondarily or tertiarily from that economic perspective, as people are vaccinated and are again inoculated and safer from the worst parts of COVID-19, people are starting to feel a little bit more confident about going out in the public. And what you'll start to see, and we're already starting to see it through various parts of the United States, is an economic reopening in these socially distanced industries. And that's really great for those individual business owners. So those that are betting against, hospitality and leisure and travel and restaurants and sporting events, plays and movies coming back, we think that's a bad bet. We think that, by the end of the second quarter of this year, it's very likely that the majority of 18-year-olds in our country will have some kind of inoculation, some form of the vaccine, and that local and state regulations and local and state regulatory bodies will continue the reopening process. And that means that final piece of the puzzle, those industries and sectors that have been hurting, they're going to really start to come back. We think it's going to be, starting at the end of the second quarter, but really in the third quarter, we're going to start to see the numbers of all those industries that have been struggling. It's going to be quite strong, we believe, because we don't think individual consumers' perceptions have changed, and we're seeing jobs come back, people's paychecks coming back, and there's this pent-up consumer demand from all those things that we as American consumers love, and we think they're going to be supercharged starting probably in the early third quarter of this year.
That's great, Tom. So you mentioned some of this sort of optimism, things coming back, pent-up consumer demand for sure. So as we kind of roll forward with the time scale, looking a little bit further into the future, can you share a bit more about where the economy is headed?
Yeah, of course. So we're pretty, as you can probably tell from, the comments so far, we're pretty optimistic. Again, we think we're big picture. We think we're at the beginning of new economic and financial market cycle. If you go back at least to 1980 in our country, these cycles have lasted 5 to 7 years, I think I mentioned. But the one that ended in March of 2020 lasted about 11 years. The four most dangerous words in investing are "it's different this time," right? It's usually not this different this time, and that past is prologue. So if we're right that we're at the beginning of a new cycle, we think this cycle is going to last many quarters and many years, and there's really reasons to be optimistic. A couple of the reasons that we're optimistic: we've got where we stand today a massive amount of monetary and fiscal tailwinds, stimulus. So the Federal Reserve has lowered interest rates essentially to zero. They've added liquidity to financing markets through a program called quantitative easing. Really, all that means is the Fed is buying bonds to make sure that financing markets remain open and liquid and deep, so that borrowers and lenders can transact in a fair manner. This is a massive tailwind to business. Low interest rates means kind of a low cost of capital. It should be an incentive for business owners to borrow and invest. It's starting to come through in some of the numbers. And then on the fiscal side, of course, if you're paying attention to what's going on in Washington, you've seen many, many stimulus measures coming out of Congress, starting with the CARES Act, the Paycheck Protection Program, starting in March of April of 2020, to the tune of over $2 trillion. Another $900 billion came directly into individual taxpayers' paychecks in December. In January, early February, there was another $1.9 trillion stimulus measure, again, to help small business owners who are still struggling. President Biden and his cabinet are now talking about infrastructure spending plans and more jobs type plans. These last two total somewhere in the area of about $4 trillion. Now, these last two have not passed Congress as of yet, but our expectation is there's going to be more conversations about stimulus. And all of these stimulus measures, whether it's from the Federal Reserve or from Congress in Washington, are adding a massive amount of tailwind to the U.S. economy to get it really up and running and back to where it was prior to the downturn in March of 2020. That's the positive side. There's no doubt about it. To put some numbers around it, the U.S. economy for the 11 years running up to March of 2020 grew at around 2% a year, a little bit more, 2.1%. Some years a little bit higher, some years a little bit lower, but on average is around 2%. This year, the U.S. economy is going to grow north of 6% a year, or kind of triple the normal run rate of the previous cycle. And the expectation by lots of economists on Wall Street is for 2022, the U.S. economy to grow about 4%. Again, that's about double the run rate. And it really has to do, at least where we sit today, from all of the stimulus that is being pumped into the economy. That's the positive side, and where we think the next 12 to 18 months are going to be quite robust from an economic perspective. The flip side is the U.S. government is paying for these stimulus measures through deficit spending. So the government is adding a lot of debt to its balance sheet. It is spending more than it takes in tax revenues. And this, left unchecked for many quarters and many years, in the long run might not be a good thing. There's hundreds of years of economic history to suggest that when governments lever up their balance sheet, you typically see interest rates rise, inflation rise, and economic output decline. Our view on that is maybe. We don't know today. I was in lots of committee meetings, investment committee meetings in 2010 when our government was doing similar things. When they're adding lots of stimulus, they're spending more than they took in tax revenues. And the concern there was inflation would run rampant and economic growth would be very weak. That never came to fruition from 2010 through 2020. So I think past is typically prologue, but it is a little bit concerning because the amount of deficit spending, the amount of stimulus is really unprecedented. We haven't seen this kind of government help really in our history going back to the Great Depression. And so from a magnitude perspective, the amount of stimulus is about 3.5 times as much as the stimulus measures that we got through the New Deal during the Great Depression. We're at about 23, 24% of U.S. economic output in this stimulus, and much of it is done through deficit spending. So the question and the thing that keeps us up at night is, will all of this debt turn into lower prospective economic growth? And we're talking about 2023, 2024, 2025, and will inflation rear its ugly head? And the answer we have today is we don't know. It's tough for a guy that's trying to predict the future when it comes to financial markets to say we don't know, but that's the honest answer. It's a thing that we look at honestly on a daily, weekly, quarterly, monthly basis. It's a thing that keeps us up at night, this specter of inflation, because of all the help that's out there from a fiscal stimulus perspective. But the answer is unclear today. I think if we do this meeting in about a year's time, we'll be fully out of the downturn in the pandemic, and we will see where prices are going. And then we'll have a better idea if we're going from a 2% inflation regime, which is normal, or a 2.5%, 3.5% inflation regime, which is not normal. And if we're in that latter one, then I think that has bigger implications for interest rates, the economy, and jobs. So I'll stop there. And again, we can come back to it later if we have time.
All right, thank you. I think it's really helpful to think through all of those different factors and on the different time scales as well. So Tom, I appreciate the kind of 30,000 foot view and understanding of where the economy is and is going. Maybe you're right. Nobody knows for sure, but it's helpful to have that understanding. All right, now I want to bring in my colleague Luis Ramos so we can talk about what this means for small business owners specifically and how we can apply some of what Tom has shared to a small business. So Luis, I'm hoping you can talk us through some adaptation strategies, and as the economy shifts and these effects take hold on businesses, what can small business owners do to respond?
Absolutely. Thanks, Meredith. So yeah, of course. So 2020, as we all know, was a very rough year for a lot of small businesses. So really, there were three big takeaways that every small business owner should have implemented throughout the past year and even moving forward. And they're listed right here. So communicate early and often. So as a small business owner, honestly, 2020 was really a big sign of, for a lot of small business owners, it's time to start breaking out of your shell, right? It is a time to really start creating a lot of relationships and opening very clear dialogue with everyone that you're working with as a small business owner, whether that is your supplier, your landlord, your banker. As a small business owner, you need to have an active communication or an active dialogue with any of these institutions or any of these organizations or businesses that are currently working with you in order to stay ahead. Because in the business world, cash is king, and in many times cash may not be available in the short term, right? So being able to talk to your landlord and say, hey, is there something that we can do? Maybe I'm not doing so great during 2020. Is there something we can do moving forward? Renegotiating lease. There's a lot of different things that you can do. Same thing with your banker. One of the most important things, and especially if you have an active business loan, is to just be ensure that you always have a relationship with your banker just to get a better understanding if problems are coming, right? Or even just moving forward, just it's always good to have that dialogue and being able to notify your banker and letting you know, hey, I may need a credit facility in the future. I may need additional tools to, continue growing my business, right? I'm seeing some issues, or you know what, I see an opportunity to grow. So having those active lines of communication are incredibly important as well. And especially as you're working with your suppliers or whoever's providing your ingredients, materials, whatever it may be, it's finding ways to get a lot of those things on credit as well, right? Being able to use those credit lines with suppliers, right? Distributors as well. Is super key as well, right? Just because you want to keep as much cash in your business as possible so that you can take care of big needs, right? Whether that be paying your employees or just keeping your operations up and running. Next, I would say one of the big things as well would be to manage your cash closely. And I think out of everything, that's kind of the most important thing that we've gotten so far. Very key is making sure that you do have some sort of cash flow management in place, right? So many times that I've worked with a lot of entrepreneurs and small business owners that don't really have a semblance or an idea as far as how much money is coming in and out of their business on a daily, weekly, or even a monthly basis. I've seen so many entrepreneurs that are very negligent in this aspect, and it can lead to problems in the near future. Unfortunately, some of them have gone out of business because of this. Just because at the same time is you can't run a business without any money, and that's what ends up happening to a lot of small business owners. So making sure that you can either find and source either low cost suppliers, right? To either pay a lower price on things, finding ways to either increase prices or just finding ways to just ensure that you maintain your existing clientele, right? Just because the pandemic has created a lot of stresses for a lot of small businesses. So with this as well, it's really just ensuring that you have a very active inventory management system in place as well, making sure that you reduce waste as much as possible, ensure that you have enough money to keep you day by day, and finding different ways to just making sure that you have cash. That's kind of like the important thing here. And then finally, aside from that, is just building savings whenever possible. So one thing that we did learn from the pandemic was that, you know what, making sure that you have money is key for small business owners. So a lot of this, I had a lot of small business owners out there that ended up looking for credit facilities during this time, whether it was active credit lines with their bank or finding working capital to get through short squeezes like this. Very important that you work with your banker, with your creditor, wherever you're getting financing, to find out what are your options, right? And more importantly, how much does that capital cost as well? You know, making sure that the capital that you are attaining is cheap capital and good for your business as well. So being able to save money, very important. And kind of like what was mentioned earlier as well, there is a lot of money that is currently being funneled from the federal level that can be used by small business owners. So one thing that I do recommend everyone in here to take advantage of is reach out to your local city. Every city has a workforce or an economic development department within their city. And a lot of these cities do have programs for small businesses, whether it be small grants or access to different opportunities or programs. There's so many things that your city can do for you as well, especially since, as you may all know, is that about 47% of the US workforce is employed by small business. So it is very important to the local economies as well. So a lot of cities do have a strong, desire and a strong need to ensure that a lot of those small businesses keep up and running as well. So I've seen a lot of employment programs that exist as well. I've seen programs where the city does cover a certain percentage of employment costs for small businesses, but a lot of it is really just doing your own research and finding out what your local city has to offer as well. Same thing can be said about the state on a state level and on a federal level. So there was a lot of money that was, through the CARES Act and through, the federal government, just ensuring that, that small businesses did have access to additional resources. So there's a lot of opportunities out there. So just stay connected, right? Do your own research, find out what's out there, and honestly apply and become informed as much as possible. And I think that's kind of like what I would have suggested.
That's great, Luis. Thank you so much. And then you already spoke a little bit about economic development or workforce development programs at the government level, local government level is a great resource. But what are some other resources that business owners could potentially look to? We have listed on the slide here some that we offer both from Fifth Third Bank and from AOF, but there are so many great resources available, and I know you're so connected in that space. So hoping you can recommend a few for us.
Yeah, I mean, aside from the ones that are listed in this slide as well, I would check out the local SBA in your area. I would also check out the local SBDC offices in your area as well. A lot of times they do offer a lot of whether it be like free educational webinars as well, or even access to grants as well. That those are things that do happen as well. Other things where you can also get additionally connected is women's business development centers, your local chamber of commerce. There's so many. There's so many to speak of as well. And honestly, I would reach out to even other nonprofit CDFIs like Accion Opportunity Fund. There are so many CDFIs, and being able to especially get connected to one that does know the local economy well, or maybe just a very local CDFI, they will have access to additional resources as well. Just because, as I mentioned earlier, there is a lot of money out there, and there are a lot of programs that are being created because of because of the pandemic and everything like that. So those are just a few opportunities as well, just to name a few. But if you are interested in others, or if you just want to pick my brain, I recommend sending an email to advising@opportunityfund.org, and I'd be happy to at least point you in the right direction.
That's awesome. Thanks, Luis. Yeah, I dropped a couple links in the chat there for folks to make use of if they're interested. All right, so now I want to turn to some questions. We've got a really active chat going on. Thank you all so much for engaging with us and sharing your thoughts and your questions. So Tom and Luis, I'll bring you both back in here. I'll start with a couple questions about the economic situation and the markets for you, Tom. So we had a couple questions about cost increases and what this might mean for the market. So, we had somebody who was talking about raw material costs increasing and the overall effect that might have on their business, and then whether there's an expectation that might stabilize. We had a couple people wondering about kind of the stability of what's been a little bit of a roller coaster market, Tom.
Yeah, it's a great question. We're seeing parts of the raw materials market seeing pretty healthy price spikes, whether that is in the commodity areas. You can look at, oil futures, gasoline, soybeans, corn, steel, copper, lumber. Again, and it is not a surprise, I think, theoretically, that those areas are seeing price increases for two reasons. Some of those areas, the raw materials that have gone into the end industries, those end industries are doing quite well. There's been big demand for manufacturing. There's been big demand for automobiles. There's been big demand for housing and housing materials. And when demand is outstripping supply, then you would expect to see prices rise. And that's what we're seeing in some key areas that are doing quite well. We're seeing disinflation, or not outright deflation, but we're still seeing disinflation in a lot of those seeing the crime industries. And so when you put it all together, on a year-over-year basis through March, kind of the core personal consumption expenditure index, this is what the Federal Reserve, core PCE, this is what the Federal Reserve is looking at for the overall picture of consumer prices. And it's really up about 1.8% year-over-year over last year. So you can find pockets where demand is outstripping supply, and raw materials and even finished goods are really spiking in nature. There's no doubt about it. But there are also other areas that are not seeing that demand, because that demand has not come back yet. What do we expect? I think as I'm sure most of you know, probably even more than I do, some of your businesses have probably been affected by supply chain disruptions globally. It's been a little bit more difficult over the last year for a lot of pandemic reasons, but also trade reasons, to source materials outside of the United States. And that has caused, I should say, bottlenecks in certain groups of raw materials getting from their factories overseas back to kind of the end users here in the United States. We think, again, as the global economy continues to reopen, these supply chain interruptions will be will be less than what they have been over the last 12 to 18 months. So our expectation is you're going to see global supply chains be a little bit more open as economies fully open, as the vaccines are distributed globally. You're going to see trade tensions likely come off of the burn a little bit with the current administration. And then you're going to see global demand, not just US demand, probably start to pick up. If that all happens, then I think you'll see this, inflationary forces and certain key inputs start to come off the boil a little bit. But again, over time, our expectation is US economy fully reopens, the global economy fully reopens, and we have this global trade really come back to the forefront, and that should stabilize some of the price increases that we're seeing. But it's a very, very good question, and it's in the media almost on a daily basis.
Mm-hmm. Yeah, I'm sure it's top of mind for a lot of people. There's one that's sort of related, one question that's sort of related in terms of the main two costs that business owners incur. There's the raw material side, sort of your inputs and your supplies. The other side is the labor market and cost of hiring, or just issues trying to hire. So we had a couple questions in the chat around the labor market sort of returning to normal as stimulus money, becomes further in the rearview mirror and things like that. Do you have any perspective on that piece around hiring would kind of return to normal soon, hopefully?
Yeah, this is great. This is something we look at all the time. We look at labor markets. So the labor markets typically are the biggest input as to affecting future inflation. It's wage inflation and housing inflation. Those are the two biggest ones that affect, overall inflation. So what we're seeing from a jobs perspective in the United States, prior to the pandemic, in February of 2020, the unemployment rate in our country was 3.5, 3.6%. There were about 152 million non-farm jobs out there. That over the course of about 6 weeks in April and May of 2020, the unemployment rate went from 3.5% to 14.7%. That was pretty much the highest unemployment rate we've seen in our country since the Great Depression. We lost about 22 million jobs over that 6 to 8 week period. We went from about 152 million jobs to 130 million jobs, and it was brutal. It was a nasty and brutal short-term period in our country. Since then, the unemployment rate has gone down from 14.7% to 6%. We've added about 12 million of those 13 million of those 22 million jobs. So we're still short about 8 or 9 million jobs relative to where we were prior to the shutdowns last year. Again, the unemployment rate is still high in relative terms. It's low to where we were last year, but it's still high over long periods of time at 6%. So there is some slack in the labor markets in general. In certain pockets, it's very difficult to hire. That's not for all industries and all sectors. But in some sectors, manufacturing is the one that we talk to our clients all the time. It's very difficult to hire in certain industries that have come back quicker and need skilled labor for, and that is manufacturing to a T. So you hear this, we're still short 8.5 or so million jobs in the country, but a metal bender in Elkhart, Indiana can't find anybody to come into their warehouse. Part of that is the forces that are out there. Those businesses that have benefited have come back quicker than many others. Demand for their end product is outstripping the supply, or how fast they can manufacture those widgets, if you will. And then there's this other piece that is kind of skewing the labor markets today, where the regular unemployment benefits and the COVID unemployment benefits, which are still intact today, and will be intact, I believe, until September 6th, have acted as a disincentive to come back into the labor force. So there's this measure that we look at called the labor force participation rate. It's people that are actively looking for a job or have a job. And this number is way, way down. It's 73, 72%. Usually it's 74, 76%. But aside from kind of the nerd speak, there has been a disincentive for people, particularly, to be blunt, on the lower end of the income spectrum, to come back to work. If I am a displaced worker, let's say in retail or travel, leisure, restaurants, bars, and I am making more from various unemployment programs that are still in place, I believe are in place until September 6th, it's a disincentive to start looking for work. So that's the other factor that people have not fully come back into looking for a job mode. So it's a couple things. There's really no simple answer in financial markets or in economies, but there's still a high unemployment rate nationally. We're still short 8.5 or so million jobs. So for the overall economy, it's hard to see runaway wage inflation. However, in pockets of the economy that have done really well, have come back quicker than others because demand for their product is outstripping supply, and they're trying to grow, with skilled labor. There is a shortage there, and there will be some wage inflation in certain pockets. There's no doubt about this. And the other piece, again, is this extra incentive or disincentive, I should say, because of the unemployment benefits are so generous today. Many workers, again, particularly on the lower end of the income spectrum, can effectively sit on the sidelines and replicate or even make more than they were working in a bar or restaurant or travel or leisure industries. So you could pick up the Wall Street Journal almost on any day and read an article about labor markets being very, very tight. And on the next page, you will read about people, there are more jobs to go around than you could ask for. So it depends what industry and what sector you're in. And again, the one thing that's kind of distorting the numbers are the unemployment benefits, which are extraordinarily generous, but those will run off. I believe it is September 6th.
Okay, all right. So there's a lot to be learned from this specific either industry or possibly even location that a business owner's in terms of what they can expect.
I think that's right.
Okay.
Yep.
Good to know. All right. And then we have just 1 minute left. I want to sneak in a last question. I find this really interesting. I'm so fascinated to know that people are interested in this. We've had more than a couple people in the chat ask a question about cryptocurrency. Apparently the SBA hosted a webinar yesterday about Bitcoin. And so, Tom, I'm not sure if that's under your team's purview at all about kind of the future of using cryptocurrency, or if that's going to affect the sort of traditional market at all. If that's something you want to speak to just briefly before we log off.
Sure. I will tell you, and it's going to be a dissatisfactory answer for everybody on the line that wants to learn more about it. We as a firm aren't going to touch it. We're not there yet. We do talk about it internally on various levels throughout the corporation. We do not recommend any cryptocurrency-based investments for our wealth management clients. As a firm, I do not believe we are custodying Bitcoin or other crypto assets in exchange. We're holding it on our balance sheets. We're not doing that for our banking clients. So, I think Fifth Third's view, at least as I understand it today, is we are investigating, but I don't think we're going to be a first user when it comes to either custodying crypto assets or recommending crypto investments on behalf of our clients. I think we will continue to learn and try to figure out this nascent industry. And if we do feel comfortable with it over the next several quarters and years, perhaps that changes. But today, we're just not there yet.
Okay. Yeah, that's all you can do is just keep learning, right? All right. Well, I want to thank you so much, Tom, for sharing your expertise today. And Luis, I really appreciate you joining us as well to share a bit more about how business owners can respond to this economic situation. So thank you both very much for joining us and sharing your expertise today. And also thank you to everybody who joined on the line to learn from our experts. I hope you feel more prepared for what's next for your business based on what happens in the economy in 2021 and beyond. So thanks again, everybody. I hope you have a wonderful day, and we'll see you at our next webinar.